Hello, Colleen and Lauren. This is part two of the presentation. I'm still on page 9. And to finish up the 100-year graph, the other comments that I want to make is that we need to stay invested because certainly the blues outweigh the reds. Secondly, we don't know when there will be another bear market that starts, a crash, so to speak, a 20% drop. And yet we know that over the long term, that it makes sense to stay invested and focus on real returns. That is the difference between inflation and the total return. The other thing that we'd like to make sure that we look at would be the fact that the hills going forward are smaller than what they have been in the past. And this is what is to be expected. So we stay invested, stay diversified, and remember that investment returns are only one key metric for your long-term planning. Excuse me. Let's then look at investment returns expected in the next several years. We first go through the need for diversification, a chart that shows that what's hot one year isn't hot necessarily the next one. Chasing performance is not the answer. Also, we look at the major asset classes and look at what they bring to the table. Equities bring the most, even though their returns will be lower than historical. Fixed is going to have headwinds as rates start to rise at some point in time. So as we look at the bottom of page 11, you will see that our expectations for the next several years, with inflation staying low, let's say 2% or less, real growth staying low, 2% or less, and the excess equity premium being somewhere in the range of 2 to 4%, equities should range between 6 to 8%. We're showing 7% here. Fixed income might range between 3 and 5%. We're showing 4%, and alternatives about 5%. So if someone had a very balanced portfolio, their return might be more like 5.75%. A portfolio that would be heavier and more growth or aggressively oriented, such as an aggressive investor would have, might be in the 8 or 9% range for total return. So anyway, we take a look at that, and that's just something to know about. Let's look at page 12. We then talk about the fact that we need to focus on what we can control in terms of diversification, in terms of low costs, minimizing taxes, rebalancing regularly, and staying invested. There are 11 metrics that are listed on page 13. We're going to come back to these, but you'll see that that investment returns are only one of those. And as you know, Colleen, we talked about a number of those in terms of the planning, your planning going forward. And of course, Lauren, we'd be happy to talk to you about this as well. We next went through a fun section on emotional biases in investing. And you'll see that the first one we talked about was the recency bias, which we all have a tendency to do, which is what's happened recently seems to have more value than long term. And often this leads to people chasing performance, feeling badly about the market when it's down, and so forth. So we've got a number of things in there on the recency bias. And again, we all know that when money is involved, emotions run high. Let's now look at page 16, and let's talk about the overconfidence bias, which occurs, the loss aversion bias, which you can see, and another big one, which is the anchoring bias. The anchoring bias is particularly prevalent in real estate, where people have bought a property, let's say at the height of a market, and then can't sell it because they can't sell it for a loss. Well, the fact is, of course, as we have discussed, that properties only have the value that they have currently, and they should be evaluated based upon their current returns and a decision made whether it makes sense to keep that under the current return conditions or consider selling it and getting a better return elsewhere. So we talk about how to cope with biases, recognizing that they exist, identify different objectives. You need discipline on this, and that's one of the areas where a wealth manager like DWM can help. Let's move on to page 18. And here we talk about some of the other financial advisors. Again, financial advisors don't need a degree. They don't need a license to call themselves a financial advisor. There are lots of them out there. You can see who they are. They range from tax professionals to bank reps to insurance people. And then there are some registered investment advisors like Debtor-Backed Wealth Management who are wealth managers as well. Some of us have heard of robo-advisors, which is not a hand-holding financial advisor, but rather a software program that allows people with small amounts of portfolios to invest their money in a reasonable arithmetic fashion. We use those with some of our younger clients, particularly those without large portfolios. We don't typically charge the children of our clients to do that. And again, we'd be happy to talk about that if you wish. At the top of page 19, you see the hoopla about fiduciaries. We, as a registered investment advisor, are required by law to always put our clients' interests first. The other so-called financial advisors are not required to do that. They simply need to find suitable products to try to sell to people. And there's a wide range of things that might be considered suitable. So they're an entirely different situation than we are. We then talk about what the preference that people have. It's pretty self-apparent. And then discuss for a few minutes our DWM Total Wealth Management process, of which investment management is an important point, but certainly not nearly as valuable as all the other value-added services. So that's our total wealth management package, as you see in the bottom right on number 19. And by the way, we have a whole process that we have been documenting over the years, which we call our Sherpa process, to do this on a regular basis. Let's turn to page 20. And at this point, we spent a little time talking about some of those metrics. We talked about looking first at all the assets that a client has to make sure that they're giving them a good financial or personal benefit return. When we talk about housing, when we talk about a personal residence, we look at the amount of expense in terms of opportunity costs that is there. If someone would consider taking the equity in the house and doing something else with it. We look at rental properties, as you know, to see which are performing and which are not. We look at additions. While at the seminar, we added a couple of exhibits that were there. We looked at a budget for a young individual and showed how even at a young age, you might put away 15 to 20% of your earnings after tax into investments in order to put together a program for financial independence in the long term. We talked about other additions down the road. We talked about investment earnings. We spent a good deal of time talking about taxes. And as you know, that's so important in this day and age to keep those down to a minimum. We talked about estate taxes, not only the estate taxes, but the administration of the estate in a organized fashion that reduces cost and harassment to the family. We talked about stress testing of the plan, which includes not only risk management, but looking at other things that could occur that could hurt the plan long term. So putting it all together then, you see on the bottom of slide page 21, the fact that really what we do at Total Wealth Management has three components: an investment management component, value-added services, and then the relationship management, where really our goal is to manage and help our clients in every aspect of their lifetime financial planning. So that's really the key, and what we had talked about at the seminar last week. From there, we had a nice question and answer period, and then we moved into the happy hour, which was also quite enjoyable as well. Again, sorry that you folks couldn't be with us, and hope one of these days you'll be with us. Thank you.